Private Lender Podcast, episode 106.
The Private Lender Podcast quote of the day comes to us from Joe Biden, who said, "Don't tell me what you value. Show me your budget and I'll tell you what you value."
This is the Private Lender Podcast, the show that shares practical advice and know-how for new and seasoned lenders, from private mortgages on single-family houses to joint ventures on commercial projects and beyond. Discover details about investment vehicles that you won't find at your local bank or online broker. Listen and learn from private lenders and real estate investors, as well as from professionals and entrepreneurs, as they share the details, strategies, and the insight that allows for successful and prosperous lending. Now, get ready to increase your ROI. Here's your host, Keith Baker.
What's going on, Lender Nation? Greetings and welcome to the Private Lender Podcast. I'm your host, Keith Baker, and you are listening to episode 106. The Private Lender Podcast is the only one that's dedicated to teaching everyday people just like you and me how to prosper with the most passive form of real estate investing known to humankind, while giving tips and ideas that can help keep your money safe with private mortgage lending. Look, it's just as simple. If you're looking for practical tips and advice on being a successful private lender or on how to create wealth without banks or Wall Street, then you're in the right place. But if you want to learn from my mistakes so that you can avoid them, jump around them, and prosper much quicker, then pull up a chair and pour yourself a stiff drink, my friend, and get ready to take notes. Because the Private Lender Podcast is made just for you. Now let me go ahead and get the legal crap out of the way. The Private Lender Podcast does not constitute an offer to sell, a solicitation of an offer to buy, or a recommendation of any security or any other product, service, or investment. We're just talking here, just rapping out loud. Do your own due diligence and make sure you stay compliant. Having said that, let's get into the heart of the matter today. Today, I've got the good fortune of talking with Jim Maffuccio from Aspen Funds. And it's kind of funny because not long ago, I decided that I was going to no longer interview real estate fund managers for various reasons, mostly because I had locked onto some green fund managers and exactly succeed. So knowing that, I wanted to be very conscious of who I led on the show, what we talked about, so on and so forth. So I just basically just said, okay, no funds, no fund managers for a while, except I was looking at a few crowdfunding, things like that. But anyhow, one of Jim Maffuccio or Aspen Funds assistants reached out to me and said, would you consider interviewing Jim on the Private Lender Podcast? And I immediately said no. I said, thank you, but I can't recommend anyone invest in subordinate liens, and especially non-performing subordinate liens. I just didn't feel like it was a good fit. But then the more I thought about it, I was thinking, who better to speak about such a topic on this podcast? It is a topic I'd like to cover, but it's one that I don't feel like I have much authority on. I have done some second lending, lending in the second position, but I just don't feel like I have done it enough to talk confidently on it. So then I decided, well, probably wouldn't be a bad idea to have someone like Jim come on and talk about it and the ins and the outs. Just because I don't do something doesn't mean that I can't interview someone who does. It doesn't mean that I can't learn from Jim's process or to help you do the same. That's the whole purpose of this platform, I think. So at the end of the day, here we go. Interview with Jim Maffuccio of Aspen Funds. And let's get down to the brass tacks in his interview. Here we go.
Baba Booey.
Hey, Lender Nation, thanks for joining me today. And I want to give a special thanks to Jim Maffuccio, who has come on to talk about his fund, Aspen Funds, and the particular niche they've carved out for themselves in second lien notes. So, Jim, welcome to the Private Lender Podcast.
Hey, great to be here with you, Keith.
And I'm excited because, as everyone knows ad nauseum, that I tell, especially people starting off, they just got their first self-directed IRA. Stay away from second liens, get the good loan to value, stay safe. The number one rule is return of investment before you talk about the return on it, so for every dollar that goes out, you want to get it back. So Jim, tell us, how'd you get started in this crazy world of distressed second liens at that? Not even good ones, but distressed.
Yeah, that's right. By the way, I agree with your statement. Stay away from second liens. In fact, send them all to me. But so in a nutshell, I'll just give you a very quick background. I was actually a civil engineer. I graduated from LSU, Go Tigers, in 1979. I saw that look on your face.
You know how many people that wore LSU shirts I worked with in the oil field, and I don't think they went to prison before they went to high school.
Well, I didn't do that. But,
so good for you. Good for you. You got your paper.
But I did go into the oil field. I actually went to work for Exxon in 1980 and did the corporate engineer thing for about 5.5 years. And the entrepreneur chip kind of turned on in me. I got my real estate license in 86 and I jumped out into transactional real estate. And then I got involved in development. So I was developing small residential infill projects in Ventura County in California, coastal California. And I'll just make this real short. I went through the S&L crisis, lost everything. That was in the, by 1995-6, I was tanked, broke, underwater, having had a 7-figure net worth going into that and all kinds of projects. All of them went dumped and went south. And again, it was because of a mortgage related crisis. I'm going to highlight that. So then I kind of got back into the game and in the 1999 started back in. And by 2005-6, there I was again, a bunch of leveraged real estate deals, development deals, doing great, killing it. Market was on fire. And I actually even had focused on affordable housing, thinking that there was going to be some correction because, values had really ratcheted up in that time frame. And that thing crashed. The 2008 mortgage crisis took everything so deep, so fast, and for so long, nothing could stay underwater that long and survive. So once again, I found myself in, around the 2010 time frame, completely broke, negative net worth in Kansas City, a new city. I'd lived in Ventura County for 27 years. And here I am in, 55 years old with 5 teenagers, 2 of them adopted internationally, and literally no immediate source of income and, no investors really to speak of. I could probably go back to California at that point and raise money again. But when you're beaten down, that's not the thing you're after. So yeah, I was flipping homes because, every other home was boarded up, kind of thing. And it was a heyday. And I was flipping homes and put some people to work doing that. And at the same time, studying the market, because whenever there's a crisis, there's always opportunity. And I kind of had an epiphany in 2010. And I saw the place to get involved in the rebound and the coming recovery was the distressed debt. Everybody was going after the REOs further downstream, and then even the foreclosure auctions, and then further upstream from that, the pre-foreclosures, working short sales. And I did some of all of that. But I thought, at the end of the day, it's where the distress starts is when a loan goes into default. So these institutions have to get rid of this paper before they go off a cliff. So I started looking into that. In 2010, I went to a conference, a note investing conference in Denver, and 95% of the content was about senior liens, buying the defaulted first mortgage and then running through. It's really a checkers game, figuring out, are you going to exit through the property or are you going to exit through the borrower, making some sort of a modification with the borrower. But there was one guy off to the side in one of the breakout rooms talking about second liens. And as soon as I saw what he was doing, the lights went on and I go, oh my goodness, this is where I'm sticking my fork into this thing, because I needed something that I could come into with minimal investment and the most multiplier effect, the greatest leverage, and buying the seconds, particularly when the first mortgage is performing. It was just genius. When I saw it, it was like, oh my goodness, this makes all kinds of sense. And whereas hard dollar equity is super important, obviously, in anything real estate related, what we learned was we could actually make more money in terms of multiple on the loans where there wasn't so much equity above our position, if any. And because there's this thing called emotional equity. And, these are people that are paying their first mortgage. So, they have an income, they want to stay in their home. And we've bought this nagging second lien that's on their property for pennies on the dollar. So we have a whole lot of room to work things out with the borrower, whether it's a one-time fast settlement or whether it's a loan modification. And that's on the ones where we have very little to no equity. So we actually make our best multiples on those, but they're low numbers. Like we may buy a loan for, we may buy, for instance, a $50,000, that's the payoff balance that the borrower owes, but we may pay $5,000 for that loan. And maybe the first 10,000 of our position is covered with equity, but everything beyond that is, it's blue sky. Well, we can go to that borrower and enter into a loan mod or settle that loan and make a 2x, 3x on our money pretty quickly if we have a reasonable and a cooperative borrower. So the good, the bad, and the ugly of this thing, we've been doing it 8 years now. full time. We've built a company. We have 20 people now, and we're focused on second mortgages. And after doing thousands of these, I'll tell you, we make between 2.3 and 2.5x on our purchase price. So if we buy $1 million worth of these defaulted second mortgages, we will pull in $2.5 million of revenue. And it typically takes anywhere, we start getting exits in 6 months and typically out to 3 years. So it's patient money because there's a pretty elaborate workout process we go through, but it's pretty good multipliers. I just wish there was more of the product. So that's kind of a nutshell of what we do on that side of our business. And then we do have another side of the business, which is an income fund where we actually buy reperforming mortgages, whether they're seconds or firsts, and we buy some hard money loans from other originators as well. And that's a way we can keep our truly passive investors that just want mailbox money. We can keep them happy with a nice preferred return. And we do all the brain damage of keeping the loans on track. And when they break, we fix them. Since that's our core competency, if we have a default rate of 10% to 12% in our income fund, we know how to do workouts. We know how to get that thing back to a performing status. So that's it in a nutshell.
All right, I'm going to back up a little bit. So is your fund for accredited investors only?
Yes. At the current time, it is. It's accredited only.
Okay. And just for education, it's the, can you run through the SEC code, the
506C is what our funds are. That's the particular exemption that we fall under. Yeah.
Gotcha. So are you guys buying tapes of houses of seconds, or is it a cherry pick piecemeal? How do you get your deal flow?
It's really everything from buying one-offs but more typical for us because of our size now is we are buying larger pools. And it's really interesting in the seconds world, you're not going to find a lot of quality product like on the note exchanges. It's really a relationship-based deal. It's not a very normalized market. A lot of the institutions that generated this paper, they charge it off their books, typically after 90 days. It's treated differently than a first mortgage. It's almost treated like consumer debt. I don't fully get that end of it, but it's charged off and it's really worthless to the institution. And a lot of them, they won't even sell that paper. It'll just expire. The statute of limitations will time it out and it'll never see the light of day. Because for one, it's just they have higher priorities. And for two, I think some of them look at the political cost of selling this paper out on the street and then ending up with some cowboy that's, mistreating the precious consumers. And, that's happened. So we're very compliance minded. We have a great reputation. We've actually been vetted at a pretty deep level by a government entity that we bought some paper from through an intermediary. And we actually had the FDIC, looking into our processes. And we actually came out with a really, it's an unofficial report, but pretty much got the thumbs up, like what we were doing was good, because we're not out to take people's homes. We have to start foreclosure probably 65% of the time, but we only end up foreclosing less than 2% of the time. And most of the time it's agreeable at that point in time. The borrower realizes I really can't afford this house. So we're very people oriented and minded. To us, a win-win is when we can cancel a whole bunch of debt for a borrower, keep them in their home, create a reperforming asset that we can then sell for 2.5 or 3 times what we paid for it. That's very typical. Those are our numbers. And so it's really a wonderful thing. It's a win-win, truly.
The bigger the risk, the bigger the reward, right? But it sounds like if you're paying pennies on the dollar, you are a couple of things. One, you're setting yourself up properly. And two, if anyone's out there listening, originating their own private loans, you don't want to sell a loan to Jim. Okay. You want to avoid selling the loan to him, especially if you listen to my podcast and take any of my advice. But so don't use this as an exit strategy, but it's there if you need. It's always good to know it's there if you need. You mentioned something that I liked. You said that these people have emotional equity in the property. So, like you said, they're performing on the first lien. I'm just curious, are these usually like home equity lines, or?
They could be, I'd say probably 30 or 40% of them are home equity lines. Others are just, fixed rate seconds that people took out whenever they took them out. Emotional equity, just basically, there's really 2 components. One's emotional equity, and then one is kind of what I call pragmatic equity. So emotional equity is, look, we bought this home, we put our own finishes into it. We've lived here 10 years, 15 years. We know our neighbors. We like the schools. Our kids have friends. We're not going anywhere if we can afford the monthly payment. If we can afford to stay, we're going to stay. You know, people don't wake up in the morning, your typical household, don't wake up in the morning and look at Zillow and say, look at this, honey, our equity has gone down, $5,000. Maybe we should sell this asset. It's home sweet home. Most of our assets are in across the middle of the country. I mean, we have some on the coasts, but I think we're in 38 states right now with our portfolio. And so our average, I just ran the numbers on the most recent pool of seconds that we bought, and it was like a 32 loan pool. And the average FMV home value was $250,000. So you can see it's right in that middle. It's right at the median pricing for the nation. So this is bread and butter housing. It's more or less workforce housing. And people don't want to just leave. They're not going to leave because they're upside down $20,000 or $30,000. They're going to leave because they can't afford the monthly nut. So, and the other thing is, so what are their alternatives if they do leave, or if we do end up having to foreclose? In a lot of cases, the homes that are securing our position would actually rent for more money than what their mortgage payment is, first and second combined. So really, if you think about it, where are they going to go? If they've been through the 2008 to 2014 cycle, there's a good chance they've modified their first, because when they had trouble paying our loan, they also had trouble typically paying the first. Some of these people are still sitting on 2%, 3%, 4%, money on their first. And it's the best alternative financially, even for them, is to stay home, stay in their house. And we have a lot of tools to help them because of the discounts we buy at. I do want to say one thing. Most of the loans we buy these days, we're buying in the 20 to 25% of the unpaid principal balance range. And those loans would typically be ones where the senior's performing and we have enough equity to cover our investment. And we've paid all the way up to in the 60% range of UPB. If we have a loan that we pay, say, $40,000 for, but it's a $80,000 balance, but even above our $80,000 balance, there's another $150,000 in equity. Tell me where the risk is in that. I mean, I would rather own that second than the underlying first, because really, if you think about it, I've leveraged my position. The first mortgage is actually my financing that I don't have to pay.
It's a crazy sub too.
Yeah, that's exactly what it is. And that's one of the reasons it's a pretty lucrative game, because so many people, including a lot of institutional players, either don't realize that you can or aren't willing to foreclose from second position. But when we foreclose from second position, there's a false, narrative out there that says we have to pay off the first. That's absolutely not the case. In most states, we have the right to reinstate the first and keep it current, even though it's not our loan. We're not the borrower on the loan. We foreclose from second, we get the deed to the property, and it's a sub-2 deal. It's exactly what you said. Now, there are states where the first does not have to let us reinstate. They can pursue foreclosure, but those are typically the states that take a couple of years to foreclose. And that gives us plenty of time to clean the property up and sell it. And I mean, we've made some incredible profits on the handful of ones that we did foreclose and where we flipped the property. So we've actually foreclosed from second and then turned around and resold the property back to the borrower, because it took that to wake them up to realize that we were serious about, securing our position. And so those have ended up being real wonderful stories, because again, here you got the original borrower that's back in place on their property and they're performing again. We had them put $200,000 down, which got us back our investment plus some. And then they're making us monthly payments, and they've been great borrowers ever since. So, we have all kinds of stories, as you can imagine, in this business.
So what I tell people is if you're going to lay a second on a property, you want to talk to whoever owns the first position and say, look, if this borrower, because I did not do this, and so this is one of my tales of woe. So anyway, I did not contact the first and put the second on the property, and lo and behold, the first went to foreclose and they wiped me out. And I said, hey, I called the attorney was representing him. I said, hey, is there something we can do here? And the guy who had the first position was even more fed up with the borrower than I was, trying to track money. He's like, yeah. He goes, you want to make it whole? It'll be $47,000, and it's yours. And I'm like, the property's not even worth that. I'm like, no. All right, fine.
Yeah.
Done. So when you come in as it's automatic that it's you're taking it over. You foreclosed out the second position, but the first lien is superior. Therefore, it stays in place. Do you have much conversation with any of the people when you purchase the seconds? Do you say, "Hey guys, we've bought this. Here's our plan. If we have to foreclose," or is it all in the paperwork?
Typically not, because the firsts are typically serviced by the major service or national servicers, and they won't give you the time of day. They don't really have these loans are owned in a trust. There's not like a single investor they can go talk to, and their servicing agreement kind of tells them what they can and can't do. Again, the handful of times that this happens, we just make the payment. We just send them the check, or in most cases, just pay online. And I don't even know if they know where the money's coming from. They don't really care. Now, by the way, you touched on something super important. When we buy these loans, that's one of the, if not the biggest part of our due diligence is getting a handle on the senior mortgage. A lot of times on the credit report, it's just right there. You can see it. They're current. They had a little tough patch back in mid 2000s. And so we know the story on the first. We know what their payment is, what their interest rate is. If their loan was modified, sometimes the mod was recorded. We can go pull that document. And we watch, that's part of our risk management. We watch that first mortgage like a hawk, because if that thing starts to slip, then in some cases, it's actually good for us. If we have a ton of equity above us and the borrower is struggling to make their first payment, then it's a pretty easy conversation to have with the borrower. Like, look, we have to start foreclosure to protect our position, but you're not even making payments on the first. Why don't we agree to a friendly sale right now? And we'll even give you a discounted payoff, and you'll put more money in your pocket by selling the property and moving on with life. Obviously, you're having a hard time, keeping your bills paid. So that actually works on our benefit. But, I hate to say this, but what you didn't do when you put that second on a property, we have to do. The due diligence on the first is, that's the thing for us. We have to find it. So.
Oh, absolutely. In my defense, it was the loan was to a very good friend of mine. So it wasn't a stranger. Yeah,
I've had a few of those.
And so, that's why it's like, okay, yep, Thanksgiving just got weird. Okay, so no more of those.
Yeah, right.
But I wanted to go back and touch on something. So the other times that I've had a second position, I would have the borrower mail me the statements where they were paid, or scan an email proof of the payment of the first mortgage was being paid every month. And so I'm curious, when you purchase a note, how are you able to do that? Is it through the borrower's credit report that you see these dings?
That's that's the main way. If the borrower's been in bankruptcy, we go on Pacer. That's public information, public access to that information. It's really when a borrower files Chapter 13 bankruptcy, they're basically under the penalty of perjury to the federal government. They're supposed to put all their financial information out there for the public to see. And, we have borrowers sometimes threaten us, like, well, if you push me on modifying this loan or working, I'm just going to file bankruptcy. And we say, hey, I can recommend a couple bankruptcy attorneys. We love it when they file bankruptcy because, for the most part, because now they're required to put all their financial information out on the table and we can go look at it. So there's a lot of ways we can see what's going on with the senior. And sometimes it's an educated guess, but if it's on the credit report, it's right there. I mean, you can see what the pay history is. You can see what their FICO score is. You can see that they've got a car payment of $700 a month. They're down to their last 4 payments. So when we're negotiating with them to do a loan mod on our second, and they say, we just don't have any more bandwidth. And I say, well, yeah, you're going to have bandwidth in 4 months when you pay off your $30,000 loan on your Lexus. Your contract payment to us is $450. You'll have plenty of room in your budget left if you don't go back out and finance another expensive vehicle. And it's, it kind of wakes them up when they realize we know a lot about them. So.
All right, man. That's like I said, I find this very fascinating, and I apologize. I'm just listening and learning. So usually no one loves to hear their own voice more than me. So normally I'm just chatting away. So I wanted to ask you. Obviously, I admire you take a business approach to this, right? So you're only going to get in there if there's a steep discount. You have a lot of margin for error, right? Like you said, there's the more if there's equity or whatever, there's tools. If they have the emotional equity. There's tools that you can use. I'm sure, credit repair helps, all this other thing to help them get them back on their feet. But I would say in order for you to operate and be successful, you must have an ultra conservative underwriting philosophy. And yes or no, or
Well, it's when you say ultra conservative underwriting guidelines, if you're talking to an institutional banker or mortgage person, they would say you're buying defaulted second mortgages. There's no such thing. It's outside of the envelope of a conservative underwriting. We have an entrepreneurial, pragmatic, very in-depth due diligence system and underwriting process. And again, we're typically buying a large pool of loans. So there's the good, the bad, and the ugly in there. But we know how to go look at the good. We go look at the fat ones that have a ton of equity. And those we underwrite. We have to know what's going on with that senior mortgage. And then the rest of it is pretty much the way you would underwrite a first. We look at what our investment to value ratio is going to be, how much equity covers our investment. Because again, as you said, we want to make sure we get that money back. And on those are the expensive loans. And so we don't want margin for error on those. The biggest surprise we ever get on those is if we buy like an East Coast, a lot of the East Coast states use judicial foreclosure, which means it's basically a lawsuit. It's a lawsuit to get the collateral back that the borrower pledged when they promised to pay you. I mean, it's kind of insane when you think about it, but it's the process you have to go through. And a lot of times we think we know what the balance owing on the senior mortgage is, but by the time, and we can dig into the court records and do a better job usually of finding that out. But we've been surprised by a couple of them where we thought the balance, say, was $600,000 on the first, and it turned out it was really $900,000 by the time all the legal fees and advances and judgment. That can be kind of an ouch. So we discount price when we buy a New York loan. I have a saying, I think I robbed this from somebody else, but it's like, there's no bad notes. There's only bad price. So I'll buy New York loans, but I'm not going to pay the same thing that I would for the same loan in, say, Missouri, where Missouri's a fast foreclosure state. It's a trustee's deed state. The values are not wild. They're very predictable. And it's just pretty easy we actually are able to protect our position pretty easily. And so those are the great states. So
that's cool. All right. Yeah. As one of my first loans, I told the guy he wanted $70,000 to buy this little strip center across the street from some refineries here on the coast. And I went and took a look at it, and I was like, I don't know, man, like just feeling really bad. And I said, look, I don't know any commercial appraisers. I'm going to have to go, dust up my knowledge on the, market and price and, all that kind of stuff, all the different types of appraisals. And I told him, I said, look, tell you what, end of the day, if this thing appraises for at least 150, I'll give you the letter, proof of funds. You can close, do whatever you need to do. And the appraiser came back and 305 as is. And so I told the borrower, I said, look, you can default on this loan and I will loan to you again. I was like, yes. I was like, of course, no, he didn't. He handled it and he worked it well. But when you have that much margin for error built into your buy, I mean, if there's ever the adage that, you make your money in real estate when you buy it, is true in this case. Like I said, no bad notes, just bad prices.
Right.
Do you find that the note obviously you enjoy it, it's been very lucrative, but for me, I like the idea of paper because I don't have to deal with contractors. I'm going to have to deal with servicers, the occasional appraiser and a title agent, but they don't usually set an appointment for 3:00 to give you a drywall bid and no show. So you've seen kind of all aspects of it. Do you think the flipping is more of a young man's game? Because I tell you, that's where I'm heading towards right now. But I don't know that I would say it's more of a young man's game. I think it's when I did flipping, and I think it's the reason most people do flipping. I did it because I didn't have enough capital to be more of a passive. Like I didn't have enough capital to go out and just buy performing loans or even non-performing loans and get them performing and hold them. So, it's the old adage, do I want cash flow or do I want, lump sum profits? And honestly, I want both. But usually when people start, so maybe this is what you meant by a young man's game. You really want to you want to build up some capital. So a lot of people will start flipping houses or wholesaling, so you get fast paychecks and pretty decent paychecks. Frankly, I mean, it's funny to hear wholesalers and flippers argue about whose model is best. And then you find out at the end of the day, a lot of flippers do some wholesaling and a lot of wholesalers do some flipping. But the thing of it is, if you're a wholesaler, by definition, you've created this very efficient acquisition machine. So you can cherry pick. I mean, if you see one, this is a no-brainer. I can flip this one and make another,
then you're going to keep your cash flow going by wholesaling. That's your main thing. And then you're going to flip a house. I love property. A lot of people in my space, in the paper space, they'll preach the sermon on, we love paper because there's no, toilets, trash, tenants, and all that. And it's just passive cash flow, and you can manage it, cash flow all over the country, super simple. And all of that's true. The thing of it is, if you think about a mortgage, let's say a 30-year mortgage, in a perfect world, it gets paid off. And in 30 years, you've had great cash flow for 30 years. But after 30 years, you've got nothing. You've got all your money back plus the profit you've made, but you've got zero. If you buy a house that has a 30-year mortgage on it, or put a 30-year mortgage on it, and you manage that properly, in 30 years, you have an asset that's free and clear that'll pay yourself and your heirs for the rest of their lives, because rents aren't going anywhere but up. So I like both. I think I'm not one of these extremists. I love having my day in and day out business be the notes. First of all, I love it now because I hardly do anything with it. I oversee some of the acquisitions, but we have an acquisitions director who's excellent. Like I said, we have this was me and my son in our basement in 2011 buying the second mortgages, and I literally was beyond broke. And now we have we're 40 on our way to $50 million of assets under management, and that's purchase price value. And we have 20 people just by staying focused on this business model and improving it. So we have systems and processes in place and an attorney network nationwide. And, there's quite a lot to the business. It's one thing to do it on a mom and pop basis. And that was fun too back then, but I'm having the time of my life now, having scaled this and having a company that knows what they're doing. So great team.
Yeah, no, this is great. I like what you've done here, man. Like I said, it's very niche. At first blush, it's toxic. Why would you do that? And that's why I was like, no, come on, Jim, let's come on and tell me about it and tell the Private Lender Nation everything about it. So how can people learn more about investing with you? Or and this is not a solicitation if the SEC is listening, but nonetheless, if people want to learn more about Aspen Funds or what you do in your business model, how do they get a hold of you?
Yeah, so we have a website. That's the best thing is just go to the website and hit the contact us and just tell us what you're looking for. It's www.aspenfunds.net. So one word, ASPENFUNDS. .us, not .net, .us, aspenfunds.us. And just contact us and let us know what it is you're looking for. We don't have an education platform. We're not selling home study courses. However, I will be happy to point somebody interested in getting involved actively in the note business. I'll be happy to point you towards some educators, some conferences. That's how I started this business, by going to a conference. We've hired our key people from conferences. All of our sourcing has the contacts have been made through conferences. So I can't say enough for networking in this business. It's a niche and it's a tight-knit little community, but there's people that are super willing to help. As far as investing in our funds, I will solicit, but I can only solicit to accredited investors. So, but that's the one thing nice about this type of a fund is we can use general solicitation, but only to accredited investors. So you can look around on the website and see what our funds look like. And we've had a fantastic track record. We actually have some institutional money that's come on board with us, both on the equity side and as well as on the debt financing. We have some debt facilities that have helped us to kind of leverage out and get even better returns for our investors. So we're having the time of our lives right now. We're just we love helping people. We have a great team, and we feel really good when a borrower is able to stay in their home. We're able to eat some of their debt, and they're super stoked, and our investors are super, super stoked because we just had one close today. I just had to send out a kudos to one of my staff members. We just did a deal where we made a 2.5x in 1 year on the loan. It's a Chicago, Illinois loan, which is brutal to work in Chicago. Cook County is the worst. I was born in Joliet, Illinois, but not in prison.
Is your brother's name Jake?
But, that's right. But it was wonderful because these people get this. So they're what they owed us was $184,000 on a second that we had paid $20,000 for. Okay, $23,000 to be exact. And our team member was able to get a settlement. It was actually a short sale. We did a pre-approved short sale, and they settled our loan for $53,000. So we made a a 2.5x in 1 year. And get this, the borrower's like, whoa, I just got forgiven $134,000 worth of debt. And we're like, yeah, works for you, works for us. No, we love it. And we do those all day. I'd like to say we do one of those every day, but I mean, we've done thousands of them.
That's excellent. That is excellent. And yes, aspenfunds.us. You can go to the show notes page for links and contact information. And so, final question. I'm going to spring this on you. Pull out your crystal ball. Wipe off the part that says COVID-19. But, there was, I think it was Kramer yesterday on CNBC was talking about a V-shaped recovery in the stock market and whatnot. And I'm curious, everyone's asked me, what do you do right now, Keith, as far as originating notes? And I was like, well, if it's not at 50% LTV, don't even come yet. If it's not a deal, don't bring it to me. But what do you see? I mean, you're buying properties all over the place. Now you are rehabbing the borrower, the tenant, or the owner occupant, the payer. But what are you seeing, number one, and what is your gut telling you is going to happen?
Well, first of all, I'll say this. If you go to our website and request this, I think there might even be a link for it. My business partner is he's put out an economic newsletter for many, many years. It's been super accurate. He takes the really big picture approach, and he has some really incredible insights regarding the housing market, and even through this COVID, which, by the way, are proving to be 100% true. I don't know if you've seen what the markets have done today.
They're up.
But the markets are on fire today. In fact, I didn't get into enough of the call options that I wanted to, but I made a significant profit overnight because I've been buying the call options on the indexes because I was a believer that, look, these companies that their stocks got devalued by 40% overnight, those companies didn't become worth 40% less overnight. So I started buying call options on the index, and I've like 5x'd my account over the last 2 months. Okay, I'm just telling you. So I just have a hopeful perspective. The housing market's up. I mean, the inventory's low. Builder confidence is high right now, and we're back to bidding wars in the hot markets. I would watch out for overheated markets on the coasts, but honestly, even if you look at it's been almost supernatural. If you look at even the people that got forbearance agreements, the percentage of them that have not used the forbearance but have continued making their payments. Did you hear the jobs numbers today? They just came out today. So Wall Street was expecting another 7.7 million jobless claims for the month of May. Did you hear what the number was, the actual number? We added 2.5 million. It was positive. So this thing is, we may have some rough road. There's going to be some reshuffling. There's going to be some businesses that never come back. But to be honest with you, a lot of the businesses were probably on life support to begin with. And, there's going to be opportunities in the commercial sector. Residential, I don't hope people are panicking, but I've gotten so over fear-based living and fear-based. We have to be wise. We have to be prudent. But I mean, there's so much emotionalism in the markets, and the media stokes it up and makes bigger issues out of smaller issues. And I just watch the markets and say, you know what? I'm so tired of it. I'm going to start investing where I see this fear. So I saw this fear in the I'm not a stock guy. I stay away from Wall Street, but I went to this thing and I saw this Standard & Poor index go, crash down. And I texted some friends on the evening of March 23rd and said, guys, I'm not a prophet and I'm not a stock guy, but my sense is that this market can't find an excuse to go any lower. And the first good news that comes out, it's going to spike up. I perfectly pinged the day. It was March 23rd. So I started backing up the truck and buying call options on the SPY ETF, and it's gone nuts. So anyway, that's my little story. I think there's tons of opportunity out there. You just have to be opportunity minded and not, don't be a whiner. We got to knock off the whiner stuff.
I couldn't agree more. I do this as my day job is it used to be corporate. Now I work from basically from home, but that happened before COVID. So when everyone started staying home, I'm like, what's the big deal?
Yeah, same here. I work out of my home for more or less the whole time since 1986. So I'm running a company remotely. I live in Colorado and our headquarters is in Kansas City. So go figure. But I want to say something too, if I may, Keith. Everything that I just said, like about don't be a whiner, I am 100% sensitive to the fact that there are some people that have really gone through and are still really going through some serious trouble. I'm not meaning this in any way as demeaning of that or being insensitive to it. I'm talking about really the financial markets and business in general. I mean, as entrepreneurs, we have to be looking for the opportunity. We have to be optimistic. And by the way, the opportunity to help people, that's really kind of the bottom line. So again, I apologize if I offended anybody with what I said, but it's really not aimed at somebody that's going through a legitimate hard time.
I felt like I knew exactly where you're coming from, because I'll give you a prime example. A good friend of mine, two good friends of mine, I try to bring together, one with money, one with a vision. And the one with a vision approached the one with money in a fashion that I would not recommend, basically hand out, give me. And then the friend with the vision said, hey, I thought your buddy was going to, give me money. I haven't started my business. I was like, whoa, wait a minute. It's the other guy's fault that you haven't started your business. I just want to get this real clear. So I know exactly, I feel like I know exactly where the whining is coming from and what you meant. Because I was stunned. I was just like, how have I known you for so long? And I still hang out with you, but it was the, it's that, I just completed reading As a Man Thinketh by James Allen, and just a phenomenal, everything starts with the thoughts in your head, and just, I've been telling everyone, read it, because and then read it again and again, because it's not just a one-time thing. It's, constantly remind yourself that, oftentimes negative emotion starts as the seeds of thought. So
yeah, that's probably my, I'm a Christian and I'm a Bible guy. And that's probably one of my favorite and one of my life verses is, as a man thinketh in his heart, so is he. And that is so true on every level of life. And you know what? I've just decided to change the way I thinketh, and it works. It's good. So, and by the way, the book that came out of, I highly recommend that. My top selling book of all times, called The Holy Bible. So. Yeah,
absolutely. Well, Jim, thank you for coming on again. Everyone, it's aspenfunds.us. Look them up. They've got quite a model, fascinating business model. And Jim, thank you for coming on and explaining it and shedding some light. And I definitely want to stay in touch with you, because I haven't 5X'd my Wall Street stuff, but I, around the same time, decided, you know what? Why not? Now's the time to, and I poured it in, and I'm only up 28%, but hey.
That's all?
Exactly. That's why I'm listening to you going, I'm like, oh, you're doing call options. Okay, no. Yeah, I'm still buying individuals. I was buying the FANG trade and whatnot. So
yeah, but that's a safer bet, But I looked at this thing and said, this thing has to recover. I didn't know the timeline, but I buy far enough out, expiration dates far enough out that I'm not going to, I can be patient. But actually, I end up getting in and out. I actually got in yesterday afternoon, just before the closing bell, with a bunch of call options. And this morning, the thing, the Standard & Poor's, the SPY opened up so much that I just immediately, right after the opening bell, I said, I'm just taking the money and running. I made 40% on that money overnight.
Legally.
Yeah. And now I'm looking at it and it's like I got out like an hour and a half too early, but I don't even think like that anymore. It's like, look, nobody ever got broke taking a profit. Right?
Look, the way I look at it is either positive or negative. The number's black or red.
Yep.
Right. And so, as long as it's on the black, could you have, should you have, would you? Yeah. Be happy, take it, and move on.
I just like to look at it like this. I had a good month yesterday afternoon.
Yeah. I mean, that's a good month yesterday afternoon. Yeah. I'm going to go call my buddy and learn options. But anyway, Jim, thanks again, man. Appreciate you coming on.
All right, buddy. Great talking with you.
Yeah, likewise. Take care.
Baba Booey.
And there you have it, folks. Jim Maffuccio discussing how he pays pennies on the dollar for non-performing subordinate liens and still makes a mint. I want to thank Jim for coming on today's show and talking about his methods and his process, because I found it extremely fascinating. And as you can tell, I just let him go a lot on today's show just because I wanted to learn. And boy, did I ever. So if you would like more information or learn more about Jim and Aspen Funds, please go to the show notes page, episodes 106 for the links. And now is the time where I grovel with you, dear listener, and thank you for being a listener and sharing your time with me, because I do appreciate it. But I do ask for an honest rating and review over at iTunes, Google Podcasts, Spotify, or whatever platform you are using to hear my voice. Please go over and an honest rating and review. Would love to have 5 stars, but you give me what you think. That's all I can ask for is what do you think I deserve? An honest rating and review. All right, y'all. Adios. Stay safe. And this here in late June of 2020, I never thought I'd be quoting Jerry Springer, but take care of each other. So besides self-awareness and prosperity, I wish you all safe and successful private lending, and I'll catch you on the next episode.
Thanks so much for listening to this episode of Private Lender Podcast with your host, Keith Baker. For more great content and to stay up to date, visit privatelenderpodcast.com. If you enjoyed today's